You're watching The Open, and we are back with David Burrows, President and Chief Investment Strategist at Barometer Capital Management. And David, we promised our audience a few stock ideas, and we hinted at gold, which has been on a record run. How do you think about investing in gold these days?
So there's an old saying, don't fight City Hall or don't fight the Fed. And every central bank around the world, outside of Canada, have been buying gold and adding to their reserves. In fact, it's interesting, the gold run has been driven by central banks, not by investors. Last week was the first big week of inflows into the gold ETFs from investors, fund managers, and individuals. Now, gold is about 40% above the 200-week moving average. If you look at previous bull markets, each leg of a bull market, 3 of them generally, ended at 80 to 100% above the 200 moving average. So there's a long way for this to go. We think the biggest risk to investors is inflation. Inflation expectations are ticking higher, and typically you get a second wave of inflation after the first wave. And with last 3 months, inflation data is coming in hot. So we aren't buying fixed income for our investors as a hedge. We're buying gold and gold producers. So we really like companies that are growing and companies that are well managed, and we think there's a great opportunity in this area. Agnico Eagle is the granddaddy of the bunch that's the best run. They're constantly lowering their costs. They've got 11 mines, lots of diversification, and they produce about 3.5 million ounces a year. Tons of cash flow.
Agnico Eagle, Alamos Gold, also on your list. Just to do a sort of a comparison, we talked about the big AI opportunity, but the fact that a lot of those AI stocks have had a big run. So if gold stocks have had a big run, when you look at the charts and you look at the valuations and you have that inflation question hanging in the air, that sort of combination looks better to you?
So we always look for groups that have gone for a long period of time underperforming. And then once a year or two in, they generally will outperform for years. If you look at gold relative to the QQQ, from 2002 to 2011, gold steadily outperformed. From 2011 to 2022, QQQ steadily outperformed and gold had no return. So this is an under-owned asset. It's only a couple of years in. We think that this could go on for a decade.
Okay, that's interesting insight. Warren Buffett's always full of insight, and we just got an update on how the business is doing and all the cash he's holding. Your last pick today has a sort of a Buffett connection.
It is. We like the property and casualty insurance market. This is where we've seen some disasters over the last couple of years that are causing premium prices to be hard. In other words, they're able to raise price. Property and casualty companies are a big investment portfolio. If we like capital markets longer term, then capital markets returns should generate returns for these investment portfolios. Fairfax Financial is growing more quickly than Berkshire. It trades at a lower valuation than Berkshire, and they have an excellent investment portfolio, and their payouts against their investment returns have been very low. So we think that we like the industry. We just think we're going to get more growth out of Fairfax than you're going to see out of Berkshire.
All right. David, nice to see you. Thanks as
for
always.
having me.
David Burrows joining us from Barometer.